Good evening, everybody. Thank you so much for joining us this evening. We have received numerous questions regarding the recent changes in India, especially related to the tax collected at source, 20%. Tonight, we have organized this webinar to address all your queries and ensure you understand how these changes impact your situation. Feel free to add your questions to the chat and we will address them during the Q&A sessions at the end. So the topic which covers how to avoid the mistakes with the new tax rules. Just to give you some overview of this presentation. CA Pranati will go through the Indian tax rules changes for the first 10 minutes. Then I'm going to present 10 minutes with the Australian implications pertaining to those changes in India. And we will have question and answer sessions at the end. And if you have many questions, we may extend the sessions accordingly. First and foremost, we have a disclaimer. This presentation should not be considered as a tax advice. It's important that you consult your tax agent and lawyers before proceeding further. Sharing this information can benefit everyone involved. To provide some context, our firm, Nobilis NRI Taxation, was formed in 2015 out of our own frustration in navigating the complex tax rules, both in India and Australia. As a NRI and Australian CPA with an expertise in the international taxation, I personally experienced the challenges and complexity of managing taxes in both countries. Our aim has been provide a consolidated solutions to address these specific challenges. And after 8 years of dedicated efforts from my amazing team in Bangalore and Sydney, we are here today. And Pranati is a chartered accountant having a many years of experience in KPMG, having a great insight into international taxation. She will go through all those changes one by one. One significant change in the recent Indian budget is the increase in withholding taxes of 20%. This primarily affects the non-resident Indians as it is a tax collected at source. It's important to understand that TCS is not a tax, but a collected amount that can be adjusted against your tax liability. If the collected amount exceeds your tax liability, you will be eligible for a refund. This change does impact a cash flow. NRIs are required to lodge a tax return to claim the refund or adjust it against other tax liabilities, taking advantage of double taxation treaty benefits. However, it is important to note that many of these changes do not apply to NRIs in Australia and other countries. You can rest assured that they are more applicable to residents than the non-resident. This is a good news for you, and we will cover those area where 1st of July is its significance, and we'll go through one by one. The real impact can be TCS is in gifting within the family members. While there is no gift tax in India and Australia, the TCS complicates the gifting money within the family members, making it more challenging. There are also issues relating to the remittance to maintain a family abroad. So it's crucial to address these issues as banks are now more cautious and require compliances with the new changes. The data matching by Australian Tax Office poses another challenge. Information captured by the Indian Income Tax Office is shared with the ATO due to the existing tax treaty between India and Australia. ATO aggressively performs the data matching and is important to ensure the compliances in Australian scenario. This includes lodging your tax returns in India to be compliant. Failure to do so may result in reminders and penalties. Just to understand the TCS with respect to the property sale, the TCS continues to be at 20% on sale price. When you sell a property for 1 crore rupees, let's take an example that your TDS is going to be 20 lakhs rupees, irrespective of whether this is a capital gain or a capital loss. So you have to be really mindful on the cash flow impact of sale of property. However, there are plans to reduce that 20%, 5% or 6% by applying to lower withholding of taxes. When you apply for a lower withholding of taxes and your cash flow improves, and which will have a substantial benefit, you don't have to wait for the refund to come. Another very important area is the other income which we earn, like dividends, royalties, fees, and technical services, and the interest amount. So there is a double taxation treaty benefits available. There is a withholding tax of 10%, and you need to lodge your tax return, even though your threshold limit is less than 250 lakhs rupees. And you can claim the refund and as well as claim the double taxation treaty benefits. This TCS of 20% shouldn't be applicable to a lot of us, and you don't have to worry about transferring your funds before July 2023. However, there are issues pertaining to this. We have added a to-do list or takeaway at the end to make sure that you don't fall into those categories, so that you can still repatriate funds after July 2023 without worrying about 20% withholding of taxes. When do you need to lodge your tax returns? And there are some changes to that. And just see that your threshold limits is exceeding. And if you take that threshold limits in India, then there is no additional threshold applicable here in Australia. And if you have any capital gains or a capital loss, you need to disclose those information and claiming a refund. And these changes makes very hard for most of the NRIs that they need to lodge your tax returns, even though the threshold limits are less. And of course, you can claim your double taxation treaty benefits. That's not going to change. So it's just a procedural issue. It's not going to impact your tax liability. Certain incomes are exempted in India, such as agricultural income, a PPF interest, NRE deposit interest, and some cases, exempted dividends as well. These are not necessarily exempt in Australia. So if you have all this income in India, you need to disclose those income in Australia to make sure that you disclose global income in your Australian tax returns. And in Based on our experience, 80-95% of our clients don't end up paying an additional taxes. They claim dual tax exemption available under the foreign tax credit rules. But it's a mandatory to disclose all this information within the tax returns. When the data matching happens, in these information should be available in your ITR. As I said before, that the TCS of 20% is not applicable to the most of the NRIs, and they can still repatriate the funds even after 1st of July. However, there are some to-do list pertaining to that compliances. So I have classified it in a very simple way, what you need to do in Australia, what you need to do in India. So you need to disclose your Indian income in the Australian tax returns, even if it is less than basic exemption limit, right? So tick the boxes in the clause number 20 in your ITR, show that you have more than 50,000 of assets outside Australia if you have one. Obtain a tax residency certificate if you want to claim dual tax exemption. Now let us look at into what you need to do in India. Avoid having a savings account as a non-resident Indian. It's against the foreign exchange management rules, may result in penalties. Now, update your address in the PAN and in the IT records to show you're a non-resident status. It's important because the banks will determine your residency status based on your savings account. If you have a savings account, rest assured that 20% is applicable to you. If you have an NRO account, the 20% is not applicable to you. So which affects the withholding taxes when you transfer the funds, and lodge your tax returns in India by the due date. Ensure all incomes are disclosed and claim any eligible refunds. Make an advance tax payment if there is a shortfall in the taxes. And should you link your PAN and Aadhaar? It's a normal, common question. As a non-resident Indians, we don't need to have an Aadhaar. If we have one, link it. It has a much more practicality than any other way. And the last one is compare your taxes to be paid under the new tax regime and the old tax regime. There is by default now the new tax regime, but there are some options where you can still claim under the old tax regime, and you can save some taxes in that area. We offer advisory services to maximize our tax benefit and assist the client in challenging situation in India and Australia. Additionally, we have a network of professionals who can help you with Indian property purchases or assist in selling and repatriating funds to your Australian bank account. You will get a high quality advice from us on time, every time. Just write to us at info@nritaxation.co.au or WhatsApp us on the number below. Let's address your questions. Please write your questions in the chat box and we will address them one by one. Thank you.